May 2025. Omaha, Nebraska. 60,000 people crammed into an arena, not for a concert, not for a game, to watch a 94-year-old man sit in a chair and talk about money for 6 hours. That's how much people trust Warren Buffett. And then, right at the end, almost like an afterthought, he leans into the mic and says, "The time has arrived where Greg should become the chief executive officer of the company at year-end." The room just stops. 60 years. Gone in one sentence. And the question nobody could shake was this: what happens to $1 trillion when the guy who built it decides he's done? That's what this video is about, and it matters even if you've never owned a stock, never heard of Greg Abel, and couldn't care less about Omaha. Let's go back to 1965. Buffett buys a textile company, Berkshire Hathaway. Mills, fabric, the kind of business that was already dying when he bought it. His friends thought he'd lost his mind. He didn't sell the fabric. He used the cash it generated to buy other things, better things, and then he used those profits to buy even more, over and over. For 60 years, here's what that looks like in numbers. $100 in Berkshire Hathaway in 1965, worth $6.1 million by the end of 2025. $100 in the S&P 500, the index that already beats most professional investors, worth $45,500. Same 60 years. Same starting point. 100 times the result. His annual return averaged 19.7%. Every year. 60 years in a row. I know that sounds like a statistic, but think about it differently. Every hedge fund manager in New York, every algorithm, every analyst with 3 monitors and a Bloomberg terminal has spent their entire career trying to hit 12%, 13% a year. Consistently. And most of them can't. Buffett did almost double that. And he did it from Nebraska, in his head. When he handed over the keys on December 31st, 2025, something ended that we probably won't see again. Here's the thing most people get wrong about Berkshire. They think it's an investment fund. It's not. It's something weirder than that. Berkshire Hathaway owns stuff. Real stuff. Companies, businesses, factories, trains. You know Geico, the car insurance company. Berkshire. BNSF, one of the biggest freight railroads in the country. Berkshire. Dairy Queen. Berkshire. Duracell. Berkshire. See's Candies, the chocolate company Buffett personally loves so much he talks about it in almost every shareholder letter. Berkshire. And then on top of all those operating businesses, Berkshire also holds massive stock positions. Apple, Coca-Cola, American Express, Bank of America. So it's an insurance company funding a railroad funding, a candy shop funding, a stock portfolio. About 400,000 people wake up every morning and go to work for a company that Berkshire owns. It's not a fund. It's more like a country with a really good balance sheet. And one man ran it all, made every major call, set the tone for all of it, until he didn't. His name is Greg Abel, 63 years old, from Edmonton, Canada. He's been at Berkshire since 2000, 25 years working his way through the company, running Berkshire Hathaway Energy, eventually getting named Buffett's successor in 2021. So this wasn't a surprise pick. Buffett had been pointing at him for years. But knowing someone is next and actually watching them run the thing are two different experiences. Abel's first annual meeting as CEO was just a few days ago, and if you were expecting something like what Buffett used to do, the jokes, the stories, the quote-worthy one-liners, you would have been disappointed. Abel came in with spreadsheets, operational updates, hard questions about railroad performance and insurance margins. He brought the subsidiary CEOs on stage and made them talk numbers in front of 60,000 people. Attendance was down. Notably, people showed up for Buffett, and Buffett wasn't the main event anymore. But here's the moment that stood out. At some point, from somewhere in the crowd, Buffett grabbed a microphone. Not from the stage, from his seat like a regular attendee. And he said, "Greg is doing everything I did and then some, and he's doing it better in all cases." That's not a polite handover speech. That's Warren Buffett, who has spent 60 years being extremely careful with his words, saying his replacement is better than he was. Make of that what you will. Abel's first quarter running Berkshire. Q1 2026. Operating earnings, $11.35 billion, up 18% from last year. Net profit, $10.1 billion, more than double the same quarter a year ago. Insurance underwriting, up 28%. By every normal metric, the company is doing well. Better than well. But the number everyone keeps circling back to is this: $397.4 billion in cash. Record high. More than the GDP of most countries in the world. Just sitting there. Someone at the meeting asked Abel about it directly. His answer: "We have our cash and U.S. treasuries. We do not intend to be beholden to anyone." Clean line. But here's what it actually means. That $397 billion isn't sitting there because they forgot to spend it. It's sitting there because Berkshire has looked at everything available in the market right now, every acquisition target, every undervalued stock, every deal, and decided none of it is good enough. Buffett had a phrase for the moment when the right opportunity finally shows up. He called it the fat pitch. The one you don't think about, you just swing. Abel is holding $397 billion, waiting for the fat pitch. When it comes, and it will come, whatever Berkshire buys next is going to be one of the biggest financial stories in years. The numbers are good. The business is healthy. The cash pile is historic. So why are investors still uneasy? Because there's something that doesn't show up in any earnings report. When people bought Berkshire stock, a big part of what they were buying was Buffett himself. His reputation, his track record, the fact that when things got ugly, 2008, 2020, every crash in between, he didn't flinch, he bought more, and he was almost always right. That's not something you hand off in a transition memo. Abel is a good operator. By all accounts, he's sharp, rigorous, and deeply familiar with Berkshire's businesses. But he's never run this thing through a real crisis. We don't know yet what he looks like when the market is in freefall, and everyone is waiting to see what Berkshire does. And there's another problem, completely separate from Abel as a person: size. When Berkshire was smaller, Buffett could buy a $500 million company, and it moved the needle. Today, you need to spend tens of billions just to register. The pool of deals that are both big enough to matter and good enough to meet Berkshire's standards is genuinely tiny. Abel was asked at the meeting, "Is there a point where you break up the conglomerate?" Absolutely not. No dividend, no split, no reinvention. Just stay the course, hold the culture, wait for the right deal. Whether that's enough in a market that wants results now is the real question hanging over everything. Maybe you don't own Berkshire. Maybe you've never thought about it before today. Here's why it still matters to you. Berkshire is basically the closest thing the financial world has to a truth teller. It doesn't hype, it doesn't chase trends, it doesn't do press releases about AI strategy. It just looks at the world and makes decisions with real money on the line, and right now, that truth teller is sitting on $397 billion and not spending it. Buffett said at the meeting that the investing environment right now is not ideal, that he sees gambling in the markets. That's not nothing. That's the most patient money in the world telling you to slow down. But the bigger lesson, the one Berkshire's entire story keeps proving over and over, is simpler than any of that. $100 in 1965, $6.1 million in 2025. No magic. No insider secrets. Just 60 years of not panicking, not chasing, not getting distracted. The market crashes, they buy more. The market booms, they wait. Trends come and go. They ignore them. That's it. That's the whole strategy. You don't need to be Warren Buffett to take something from that. You just need to stop treating your savings like a lottery ticket. So here's where we are. Berkshire Hathaway is making money. A lot of it. The businesses are performing. The cash pile is at a record high and growing. Greg Abel is in charge. He's not Buffett. He was never going to be Buffett. But Buffett himself, who has been careful with praise for 60 years, told you he's doing the job well. The conglomerate isn't breaking up. No dividends, no reinvention, just patience. And $397 billion. At some point, something in the world is going to break. A market correction. A great company in trouble. A deal so obvious it can't be ignored. And when that happens, Berkshire is going to be ready for it in a way that almost no one else can match. The Buffett era is done. But the machine, still running, still patient, Still waiting? If you got something out of this, share it with someone who'd appreciate it. See you in the next one.